Very good morning to everybody. Thank you for taking time and attending today's session. So I have been working with clients on their financial planning and wealth management since the last 10 years. And a very common question that I come across, is, how much of real estate and gold is enough for me in my portfolio. So this is why where I thought, this would be a good topic to discuss based on the current scenarios, what are the prospects, in the coming years. So there we are to discuss about real estate and gold. Is preferred choice a smart choice, or what is the ideal, ratio that we should be looking at when it comes to real estate and gold? So let me start. So let's see what's the agenda for today. Let us see what are the preferred real estate and gold investments, the categories of where real estate and gold investments are usually done in India. What are the factors driving these investments? What are the decision-making factors that an individual or the markets consider, or the overall picture of how these investments are driven across the economy? And what is the outlook for real estate and gold in India as of now? And the disadvantages and advantages of both the investments. Every investment has its own pros and cons. So we'll discuss the same for real estate and gold as well. What is the correlation with the markets, with the stock markets of these two products, and how how they have fared in the past, and what is the current trend looking like, and what are the current trends as per as an investment avenue. We will have a look at that as well. Lastly, we will see what should be the ideal allocation in one's portfolio, and we will be taking up your question and answers after that. So, before we begin, we need to understand assets. What are assets? Assets are classified generally into two categories. One is the physical assets and one is the financial assets. Physical assets are mainly the ones which have a physical presence, like real estate, apartments, land, buildings, gold, silver, commodities, and other commodities. Financial assets are the ones which are monetary based, which are easily liquidable into cash, like bank deposits, debentures, or debt. We can call it as equity, whether it's shares or mutual funds, government securities like bonds and other NSCs and other stuff. Preference shares or any other kind of shares which have a fixed percentage attached to them, fixed percentage return, and mutual funds, right? So these are the categories of physical assets. Now, when one is choosing an investment avenue for the surplus money one is having, so it's always confusing, which one to choose. So it is sometimes it is out of curiosity, or out of interest, or out of past experience. These decisions are taken whether to go for physical or whether to go for financial assets. Now, let us run a poll question before we begin the discussion. Sanjay, can you please run the first poll question, please?
Sure.
So, is real estate your preferred investment option? Yes or no? Yeah, so we have the real estate line going ahead. So yes, real estate is definitely a preferred investment option in India specifically. Yeah, I think we have the poll answers. So 56% have voted for a yes. So this itself clearly shows, out of the participants, about 56% of them have real estate as a preferred investment choice, and no doubt it is a preferred investment choice across India. Yeah. So yeah. Now, what is real estate investment? When it comes to real estate, there are two parts to it. So one is the self-occupied property, and one is the investment related. Sorry, the investments related property. For example, somebody is wanting to buy a first property for self living as a self occupied property. So that is not considered as an investment. So that is something which has its own sentiments attached. It has its own advantages and beauty, because we Indians are very much into a family kind of a setup, and we like having a family atmosphere, and we like to build our own homes, right? So everybody has one own home in his or her life, which is their self-occupied property. Apart from this, whenever there is surplus cash or surplus money coming in, so Indians prefer to put that money or invest that money into a secondary property, whether it's a land or whether it's a built up property. So here, when we are discussing about real estate investments, we are looking at it from an investment perspective and not from a self-occupied perspective. So when these investments are made, generally the expectation is at two levels. One is the capital appreciation, the growth rate in the real estate that we are investing in, and secondly, what is the income generation we are trying to achieve here. It could be a rental property, or it could be an agriculture, a farmland, or uh, a tea plantation, or anything of that kind, right? So what is the income generation prospect of this property? So in these investments, why are these investments made? Generally, is to diversify the portfolio, to look at it as an alternative source of income, a passive income, and over a period of time to build wealth. So, which are the categories or the types of real estate, commonly chosen for investment purposes? Duplex houses, apartments, single-family homes, vacation homes. Vacation homes are coming up like a craze or a trend these days. Like people want to, have a house in places, exotic locations like let's say Goa or somewhere where they want to go and spend their time alone, away from the hassles of the work life, and have a holiday home kind of a thing. So condominiums is again a small what do you say, a studio apartment kind of a thing which can be rented out, townhouses, etc. And another category is commercial properties like shops, warehouses, office spaces, co-work spaces, industrial, buildings and things like that. So these are the, investments. So now, why is real estate investment preferred? Basically, because of these advantages that are attached to it. One is the safe option. The risk compared to other asset classes like market linked assets or whether interest rate linked assets. So real estate is quite safer, is what people feel. And because over the years we have seen that real estate tends to have a growth rate which is always upwards, right? So that is a safer option. Then leveraging, for example, when we take a loan, our own investment is lesser required. We can always go for a loan to buy a property, so we can have a leverage option there. That is one. Inflation hedging. So it holds its value. The appreciation, the land or the apartment has its value appreciated over a period of time, which investors feel that it is like an inflation hedge. Tax exemptions, when we take a home loan, right, we can take tax exemptions. Now second home loan is also allowed as a tax exemption. The interest we can claim under section 24, and the principal payment is also up to 1.5 lakh. Interest rate we can interest payment we can take as a tax exemption up to 2 lakhs a year. So tax advantage is also there. Like I said, you need a smaller portion. For example, 10 to 20% of the down payment itself needs to be arranged from our side. The rest we can always avail a loan. Again, given that our credit score is good enough. There are no entry barriers to investing. Like you don't need specialized skills to to understand the real estate market or real estate investment. So if you find a proposal which is interesting and attractive enough for anybody, so we tend to go and invest our money there. Passive income, like I said, I was saying, the rental income opportunities that we see, it's like a passive income that comes in. So that is why it is a preferred option. Theory of demand and supply. Housing prices have nowhere to go but upwards always. So there is always demand, there is always supply, which is like a cycle going on. The other plus points that one sees while investing in real estate is, the rent. Usually, the rent that comes in can be used to pay off the EMIs. So that negates over for some period of time, and then once the loan is repaid, you have it for yourself, the income is coming in. The self decision making, like I said, it doesn't need any advisor or any help required. So that is one. And because it's a physical asset for most of us, especially, it's like a status thing. We feel in a society, our status is good if we have a lot of real estate. A feeling of ownership is there because we are able to see and feel the property, because it's physical in nature. So this feeling of ownership is also there. And when it comes to real estate, houses, and the land and things like that, Indians have their own good sentiments attached to real estate. So this is why they are preferred options. But let me take you through the cons of each of these, right? So when we say safer option, let me take the first one. When we say a safe option, how safe, why is it safe? The other side to this is, it has its own risk. For example, let's take leveraging. So, in order to have many properties, overburdening oneself with a lot of loans, you will, somewhere down the line, you should know where to put an end to it, or what is the threshold one should have when it comes to loans, right? So overdoing loans will get you in the debt trap, which affects your whole cash flow scenarios. For example, if you're a middle-aged person who has children's education goals and your retirement planning down the line, yes, real estate is also a retirement planning option. But then, if you're overdoing debt, then you should be really careful because your cash flows will be strained. And today's times are a little uncertain, right? Because we don't know what happens in the global scenario. There are a lot of job cuts. There is a lot of, there's a fear of recession, and there is, risk of default is there, which again puts not only us but our dependents also at risk. So overdoing a loan is one thing which we should be careful here. Inflation hedging. Now let me give you an example. I have a relative, and because I'm a financial planner, I advise them as well. So we sat down to check on the asset allocation, on the overall asset allocation. So we found that the family is a little overweight on real estate. So we decided, because the children's education goals are coming in the next 5 to 7 years, we thought liquidating one or two properties will be a good idea, because the growth rate over the next 5 to 6 years has to be greater than the real estate growth rate. So that was the expectation, and that's why we started to look at liquidating one property, which is in a prime location here in Bangalore, in Vijayanagar. Vijayanagar is a very prime location, and this property is also at the heart of the place. So when we started looking for a buyer, we found a buyer, and this property was purchased in the year 2002 or 2003 for about 25 lakhs. And there was an agreement to sell it for about 57 lakhs or something. So the absolute return is more than 50%. So my relative was quite fascinated, and yeah, it looks good, right? So something which was bought for 24, 25 lakhs is now giving you 57 lakhs. So it's good. So we did the deal and everything, and then now coming to the tax perspective, I have to calculate, what will be the tax implication, because real estate properties have a long-term capital gains tax, right? So we started to do the calculations, and what happens is, in real estate capital gains calculation, there is something called as an indexation benefit. That means you have to adjust your purchasing cost to the inflation, so that your purchasing cost goes up. Because from 2003 till now, the properties costs have gone up. There is inflation in the economy, right? So what is the fair value as per inflation as on today? Because the gains are taken as on today, so the purchase price also has to be adjusted. Because clearly the gains are here, 57 minus 25, about 22 lakhs or 25 lakhs around, right? So we calculated. So then what we realized was, after the indexation benefit, it was not a gain, but it was a loss, in fact. So what this shows us is, after adjusting in inflation, this particular property, which is at the prime location in Bangalore, was not able to beat the inflation. right? So when it comes to adjusting inflation, this property was, not good enough. So this is one example. So there could be several examples like this. Sometimes it works out to be good, sometimes not. So it depends. So inflation hedge as such is very subjective. Tax exemptions. Yes, tax exemptions, but there are certain limitations. If you are taking a loan for more than 50 lakhs or 50 to 80 lakhs, the maximum deduction you are going to get is about 2 lakhs. But the interest that you will be paying throughout the tenure is much, much more. It might cross over 1 crore as well. So if it is a 15-year loan, 10 to 15-year loan, you tend to pay more to the bank, right? So that is one. Small capital invested, required to invest. Yes, this is fine. No barriers to investing. This is also fine. Passive income. Now coming to the rental incomes. So the rental incomes growth rate is not great. There is an opportunity cost attached to this. I will show you a slide of what is the rental yield in India across several cities, and it's not more than like 2 to 3% or max 3.5% in some cities. So rents have their own pros and cons. Like we had a COVID kind of a situation. Even commercial properties didn't fetch rent. Residential properties also suffered a lot of vacant times. So those are some of the situations we have to be considerate about. So that is how we look at it when it is a preferred investment. We have to be careful and not to overdo any investment because there is concentration risk, and you have to look at the opportunity cost. Like if this money is invested elsewhere, what is the best I can get? If that is coming somewhere bigger, then you should definitely give a second thought to this. There are some more reasons why Indians prefer real estate investments. One is the FD rates. They are not great. Yes, currently there is a little bit of hike, but as the inflation will stabilize in the country, RBI will reduce the rates further down, which will again bring back to the previous levels, right? So FD rates are not that attractive like how it used to be 10, 15 years ago. So it is no longer a safe destination to park our funds. So we look for other safe options, which we feel real estate is one. Gold investment, if we put our money in gold jewelry, for example, there is theft issues. Then you have to, carrying issues, how to, store the gold, and risks associated with that. And more risk is also riskier to life as well. So that is one of the disadvantages or limitations where people see, okay, let's shift to real estate. The stock markets, yes, they are very unpredictable. And that is why people feel I don't understand the stock market movements, and they're not comfortable to see a downside uh, per se with respect to capital invested. So that is when they move out of or they just stay away from stock investments. Another alternative that anybody want to see is startup investing. Not all the startups turn out to be profitable. For example, even the IPOs per se. So we don't know. We don't feel safe there. So that is why Indians prefer. These are some of other options, reasons why Indians prefer real estate. Now, coming to what are the driving factors in the economy which will drive the real estate market as such? How the real estate market shows its demand and supply movements and everything around it, right? So, first one is the demographics. Demographics is the age criteria, the people's preferences over a period of time, which shapes the choice of investment of real estate they make. Okay, sometimes you feel that there is a lot of demand for land. There is sometimes a lot of demand for agricultural land. There's sometimes a lot of demand for apartments. Sometimes a lot of demand for villas. So it keeps on changing. So the demographics keeps on changing. Uh, what the younger population prefers may not be the senior population prefers in terms of doing the real estate investments. The interest rate scenario. The government is coming up with a lot of affordable housing, schemes as such. So, what are these, government measures, policies, subsidies, which are driving the wholesale markets? When people have a lot of surplus cash, when there is a lot of liquidity in the economy, then we see that these forces are driving the real estate market. So what is the outlook for real estate sector as such in India? So IBEF is Indian Brand Equity Foundation, from where I've taken some of the data. This is an organization which comes up with this is a very standard and reliable source for real estate research in India. So what is the robust demand? We see that there is a lot of demand for data centers, residential properties, which is coming up, right? So because of this demand, the sector is expected to do well, and the market is really good. So another is the attractive opportunities. So Indian firms are expected to raise a lot of money for infrastructure and real estate investments as such. And there is there is a company called Blackstone, which is a private market investor, which has invested significantly in projects in India. So given all these scenarios, there is a lot of growth expected in the real estate sector in India as such. Then there is policy support as well, right? So Indian real estate is attracting a lot of FDI investments into the markets, and even the government is coming up with expansion capex projects and infrastructure and all that. So the growth prospects for India is looking very positive, and because of all these, the sector as such is looking very promising currently. And more some more points, like real estate is the second highest employment generator after the agricultural sector in India. So that is because of the previous slides points that I discussed. So the market is going to see a lot of employment opportunities, which means again there is income generation. The GDP growth rate is going to go up because real estate sector associates a lot of other sectors also, right? The skilled laborers, unskilled laborers, the cement industry, the steel industry, and all of that, right? So the GDP is also looking promising, the GDP product projections. And India is expected to reach 1 trillion US dollars in market size by 2030. That is making the buzz. So real estate sector is going to be one of the major contributors to that. Now, yes, like some of the flip side of real estate investment. Yes, there is a lot of positive side, and outlook is very good for real estate investments. But you also have to be careful about what is the flip side of doing real estate investments. Real estate investments takes a lot of time and effort. If you have to purchase a property, you have to spend time, go see, validate with a lawyer about the property. You have to spend literally time, effort, and money as well to get all these things in place before you zero down or before you narrow down to buying a particular property. Income can be variable, like I mentioned, right? So because of the COVID situation, we saw that rental income was not coming. Now slowly the rental incomes are coming in, but not to great level because of the hybrid model that a lot of companies have given. So people prefer working from homes for half of the month, the next half of the month, they have their office guest houses or something to where they can make arrangements. So rentals are coming in slowly, but we have to wait and see how that goes. So depending entirely for an income through real estate is something risky. Uh, we should have a look at that. Income is subject to taxation. Again, rental incomes is subject to taxation. It is taxable in the hands of the investor as per the income tax slab rates, right? A lot of maintenance issues come up when maintaining a property. So if 9 months, if you're getting rent, then another 3 months, is spent in repairing, painting, redoing, finding another tenant, giving money to the broker to find a tenant, or a lot of these issues are there with the real estate investments. Transaction costs are high, like there's a lot of paperwork involved. You have to pay to different parties, getting registered and transferring costs, stamp papers. So many transactions are involved, so the costs are really really high. Real estate values can decline as well. Every asset has this particular angle. The values real estate values, like I was mentioning the example, right? When it comes to inflation beating, sometimes it's not a viable option. These are some of the things you should consider. And real estate is definitely not a very liquid form of asset. So when you're investing for children's education or for retirement purpose, you should be careful there because it's very difficult to find a buyer for the real estate. Right. So I'll give an example. I had a client, coming a few years ago, and he wanted to sell a property. So the purchase price, I'm not sure, but somewhere he was expecting about 1.8 crores for his property. But he was not getting a buyer at all. He and we also have to try to look for a buyer. So the max that he was getting was about 1.65 or 1.7 crores. But he was not willing to give his property at that price. He was very keen on then he decided not to go ahead. Although we suggested, it's good, because he had invested that property for again for child education, which was coming up. Then we showed the pros and cons, and I suggested that coming out of the property and putting it into a good mix of financial assets will help the goal. Because the opportunity cost is much higher. You can earn a growth rate post tax and everything about 12 to 13% in the next 7-8 years. But he was not comfortable and he didn't go ahead with that selling option. He said, let me wait for 1 or 2 years more, and I'm sure the price will go up and I'll sell at that point of time. So we said okay. And now after 3 or 4 years, the property prices are still lingering at the same rate, 1.7 crores to 1.8 crores. So the last 3-4 years, that 1.8 crores has lost in making money elsewhere is something which we cannot undo it, right? So these are some of the things we should consider when it comes to liquidity and growth rates perspective. Yes, I was talking about rental yields, right? Rental yields is nothing but your net rental income divided by the total property cost. So rental yield across various cities, you can see, is not, on an average, you can see it's not more than 3.5%. 2.5 to 3% is what we see. So meaning that your rent grows only about 2% to 3% on an average. So this is not worth the time, effort, and money that you're putting in to look after that property, to property taxes you're paying, and you're paying to the brokers or something, or some platforms you must be using, the fees that you're paying to get your tenants. So these are some of the cons of rental yields as well. So now, what is the ideal allocation to real estate one should look at in a portfolio? So if you're considering as a whole, real estate as if your self-occupied property plus your investment properties, it should not go beyond 35 to 40%. If you're in the range of 25 to 30%, it's very good. Just stick to that and don't overdo it. But at the max you can stretch is about 35 to 40%. Beyond 40%, it will be like a 50% allocation of your total portfolio, which puts your returns at risk. Inflation is not taken care, and liquidity, of course, it's a problem, right? So if you have bigger goals coming in, then you should stick to these percentages. Again, it is very, very subjective. So we as financial planners have to really do a deep dive to understand what the components, the overall components of the asset allocation are, and what are the goals in line, short, medium term, and long term goals, and how these assets, these real estate investment assets, can be placed for the goals that they are intended to, and what to do about it, how income generation can be taken care. Is there an alternative source which can be replaced by real estate? So things like that we'll have to consider. So if you are excluding the real estate, the self-occupied property, and looking at only the investment property in your overall portfolio, then it should not go beyond 20%. 20% is the max allocation that you should be looking at for an ideal real estate allocation in the portfolio. So, what are the current trends, which I have come across and which my colleagues have come across with respect to real estate investments? So, we are seeing that these days, a lot of our clients' children are, going abroad for studies, and they are finding a job there and settling there. That is one scenario I'm just giving. So, if nowadays everybody has one kid or max to max two kids, right? So if both the kids or one and only son or daughter is settled abroad, parents usually prefer to just shift and live in a place where their children are staying. So what happens to all the real estate investments in India? The children are not very keen to come back and look after these properties. So it is becoming a challenge. So this is one of the trends that we are seeing, that they want to give off or sell off their properties in India, and just wind up and go back. But everybody, everybody who is trying to buy a property wants to buy a new one. So used properties market is a little bit down, I would say. I was talking to one of my friend the other day. So she wants to sell her apartment, old apartment, some 7 or 8 years old apartment, and she's listed it on one of the websites, a broker websites, and they are charging some 7-8 thousand for a year to find a thing. So it's been past 1 year. There have been no action as such. It seems that it's like a scam that is happening. The website people, they send some people from their own team to just show interest and things like that, but they are not the actual buyers. So it's just that there's a scam going on, she was saying. And just now, when the renewal time is coming, the membership renewal time is coming, they are showing some promising deals. Like, we have a buyer, you should get your subscription renewed, and we'll have this deal closed very soon, and things like that. But who is the person and what are their credentials? Nothing is being shared transparently. So, these are the practical challenges one should consider when it comes to real estate investing, and what are the current trends. A lot of millennials as such, I was speaking about children going abroad and having living there. So children's fascination towards physical assets is a little low these days. They are more fascinated, are more inclined towards gadgets and other lifestyle assets as such, rather than gold and real estate. So if we feel that we are doing investments for our children or something, we should sit down and discuss the pros and cons, and take a wise step as to how much allocation you want to have there. Is it better if you instead keep money for your child, and that can be used by him or her? Because kids these days are very, very smart, and they want to do something of their own. A lot of kids are inventors, innovators, and they want to have their own startup and stuff like that. So we should think, like, whether it makes sense to have have financial assets instead for them, and also for our retirement. So those are the things. Even few working class people who are in their 45s and 50s, so they want to start their own venture. So for that, they need money. Financial assets will be more useful. So those are the things, current trends that are going on. So we should be considering those as well. So there's one alternative to physical real estate investment, that is the REIT, the Real Estate Investment Trust. So some of you must have heard of this, and for some others, it must be a new concept. So yes, this is a new concept in India. It has just started in 2019. It was introduced earlier in developed economies. It's called, it works just like a mutual fund. uh, they pool money from investors, and they use that money. You are given units of properties. You can buy one unit, two unit, just like you buy units of mutual funds, right? Where you're actually not buying the shares, but you're buying the units of mutual funds. So real estate REITs work in similar way. We call it, in short, we call it as REIT, REIT. So that is one option. Excuse me. Let's look at how this works. This is a new concept. This is a very risky asset class as such, because it has to still go through a lot of um, what do you say, process. It should, a lot of process has to be come in, and it has its again pros and cons there. Instead of having physical real estate, this is still a preferred way of investing by some of the ultra high net worth individuals. Some of them are considering investing in these ways. So how the structure works is there is a sponsor. Sponsor is a group of people who want to give their money to the real estate investment trust to invest on behalf of the investment, on the investors to in the real estate properties. Now, unit holders are investors, right? So we invest and we get units of these mutual funds, these funds, real estate investment funds. So how do they earn their income? They earn their incomes from the rental income of the properties and the price appreciation of these properties. And what kind of properties that they invest? They invest in bigger office premises, for example. That is one category. And so that is, the projects are very huge. If we want to invest in such projects, a lot of investment will be required. Here we can take the benefit of both the worlds. With minimal investment, we are getting to enjoy the price appreciation and rental income appreciation of these properties. So there's a project manager appointed and a lead manager appointed. So this is how it is a it works like a mutual fund. There's a professional fund manager who is taking care of these investments, how to generate these incomes. They pay in three structures basically. One is they give you interest income, they give you dividend income, and there is capital gains also. So these are some of the regulations that are, they come under the purview of SEBI. And as per SEBI, they are required to pay out 90% of distributable cash flows to unit holders. So 90% of distributable cash flows is the 90% of the profits they have to pay away to the unit holders as an income to the unit holders. They must have at least 80% of their assets to be completed and income generating. This decreases the execution risk. So what does this mean is, unless and until a project is 80% complete, they cannot invest investors' money in any other project. So they have to ensure that 80% of the projects that they are investing are worth generating some form of income, and then only they can move to other investments. The sponsor is obligated to hold certain units of REIT so that they have the skin in the game, and remaining are issued to the investors in the form of IPO. Once listed, this serves as a permanent vehicle to raise debt. So REITs also raise debt from financial institutions, banks, to make profitable investments. Apart from investors' money, they also raise capital. So that is how they make sure that the new assets are taken and they are grown. What are the limitations of REITs? They have limited options. This is, like I was saying, this is fairly new to Indian market. So there are only three major players of REITs here. Liquidity. The REITs, although they are traded on stock market, unlike shares in mutual funds, you will not find actively there is a ready buyer who is ready to buy the REIT units if you want to sell it. And selling a REIT unit is, involves a lot of paperwork and some other practical issues with respect to, custodian and things like that. Taxation, yes, the interest income and the dividend income, again, both are taxable in the hands of the investors. And capital gains are also not free from tax. Capital gains are also taxed in the hands of the investors. So this is a very, very highly risky investment. It has a weak growth and high fees are involved in the processing, in the purchasing of REIT units. There's a lot of transaction involved in REIT investments. This is a very, very big subject to discuss. So maybe we will come up with a separate segment to discuss all about REITs. So what is the key metrics we should look for when one should look for, when investing in REITs is the weighted average. These are all, too much at one shot to understand, but let me just try and simplify it for you. So weighted average lease expiry. So usually these properties and that are invested are bought for leases. So the time left for the property to go vacant is the um, is a time which should be considered for income generation purpose. The higher the lease expiry period, the better it is, because for that much of the period the income is there. Distribution yield, the higher the better. Some REITs have higher distribution ratio, the profits that are there, how much of it is distributable to the unit holders, that we have to look. So the higher the ratio, the better it is for us, because we are getting income from there. Loan to value, we should always see that any REIT is not very high on debt, because then that becomes a debt trap, and they are in the loop of prepaying more towards it than to the unit holders. Net distributable cash flow, yeah, it's the same thing again. High occupancy, the higher occupancy, the more stable the cash flows. So if it is a office spaces related investment, then we should look at how profitable or how much is the occupancy ratio, how many people are turning up in the office spaces, where the rent is generating. Because let's say any particular office, they would have taken 3 to 4 floors, whether all floors are occupied, or whether they are able to generate that kind of an income. So those issues will be there. So diversified portfolio, how their real estate investments are diversified across different locations, different cities, whether there is over concentration risk. So we should all have a look at that. Net asset value is nothing but your total assets minus your expenses or your liabilities. So net asset value should always be more to make it as a profitable or a viable investment solution. The sponsor should have a good brand name, because a brand has a good trust factor, and which is a recognized one. Taxation, like I have mentioned, so the interest and dividends are taxable, and capital gains are also taxable. So how to invest in REITs in India? So REITs are invested through regular trading platforms like BSE and NSE. So one should have a demat account to invest in these. And there are only three REITs in India as of now: Mindspace, Brookfield, and Embassy. So it has just started in 2019. This was just to give you a overview of what else is there in real estate as an alternative. So these are riskier assets. So please, you should be aware of a lot of things before getting into REIT investments. Now, let's move our attention to gold, which is our another topic for the day. I hope I'm not running out of time. So it's already 11:45. Both the topics are very comprehensive, so it might stretch a little. Please bear with me. I'm sure this is going to be interesting. We all know that India is one of the largest consuming nation in the world for gold. We have a lot of demand for gold in India, right? So we are just next to China. China is the highest consuming gold consuming nation. So now let's have a poll question here. Is gold your preferred investment option? Yes or no? Sanjay, can we please run the poll question? Wow, we are seeing that most of them have answered a no. Yeah, I think we have the poll. So 52% say it's a no, but it's a very close uh, close mixed reaction, mixed answer actually. So like no, it is preferred by most of us. Right, so let's see. So in what forms gold can be invested in? The most preferred is gold jewelry or gold coins and bars in India. So gold jewelry is the easiest way. You just go and buy whichever design, whatever piece you want to buy. And gold bars and coins is like, occasional, like for a festival or something. Apart from gold jewelry, people tend to go and buy gold coins or bars, like an annual investment. Then we have gold ETFs. ETFs are exchange traded funds. This is an online mode of investment. Demat account is required to invest in gold ETFs. Then we have gold mutual funds, gold-based mutual funds. People do SIPs there also. Gold mutual funds may, and some other investors also invest in sovereign gold bonds. This is a government-backed, gold investment. So we'll have a look at each of these in detail. So these are the most common ways of investing in gold as a category. But usually, gold jewelry takes a leading hand, especially due to marriage season, festivals. So gold jewelries are the most preferred ways of investment in India. So let's look at each category. What is the minimum investment required? Physical gold, of course, yeah, it depends. Less than a gram also people can buy, but when it comes to investment, at least 1 gram will make sense, right? So that is the minimum amount that will be required. In gold ETFs, the minimum amount of investment required is 5,000. That is approximately price of 1 gram of gold. So on an average, it's around 5,000 these days. So I've taken 5,000. Sovereign gold bonds also the same. At least you should be investing in 1 gram of 1 gram, 1 unit of sovereign gold bonds. Gold mutual funds, you can do an SIP of minimum 1,000. If you're doing a lump sum, 5,000 is the minimum investment that is required. Now, what are the pros and cons of having a physical gold as an investment? Now, again, I'll go back to the same explanation that I gave in the beginning of real estate investments. Here, they're talking about investment gold and not the jewelry which we use, gold jewelry that we use for daily wear and for functions. The women have a lot of attachment towards gold jewelry, so we're not talking about that. We're talking about investment gold, as in gold coins or gold bars or jewelry for daughter's marriage for the future. So those kind of investments. So what are the advantages? This also doesn't need any specialized knowledge. Risk. This is looked at a very risk-free asset class, and wealth creation is achieved because gold prices are always increasing. It acts as an inflation hedge. Yes, it is definitely an inflation hedge. It is highly liquid because we can anybody can go to a shop and sell it across. Of course, the wastages and making charges and some transaction cost will be there, but it is liquid, so you can go anytime and liquidate the gold. Portfolio diversification. So people feel that I have diversified assets. All don't put all your eggs in one basket. So this is one of the ways people feel is diversification. And most of the times, gold can be kept pledged, and a loan can be taken against it. So in times of emergency, in times of extreme situations, this comes handy. What are the disadvantages is it's like locking your money into this product, this asset, which is not giving you any regular income over a period of time. Physical gold is more prone to theft and risk to life. There is difficulties to store at home. It is very risky to store at home. So we have to look for a locker, and getting a locker these days in our nearest banks is a hassle. So difficulty to store gold becomes a challenge. And gold prices are impacted by major movements in the international market. So international demand for gold as a commodity is what determines the movement in the gold prices. So that is, these are the factors one should be careful. So let's look at, we know physical gold as jewelry and gold bars and coins. It is very easy to understand them. It is very easy to go and buy them. How do gold ETFs work? Let's take a look.
Hi, in this video, we will discuss and highlight the key aspects of gold ETFs. India is the largest importer of gold in the world. Many Indians are very fond of investing in gold as an asset class. But most people invest in physical gold by buying gold ornaments and jewelry. Investing in physical gold has many barriers. Firstly, they come in with hefty designing and making charges which jewelers demand. Then they have issues with determining their authenticity. You will need an expert to always determine the quality and pureness of the gold. Lastly, they cannot be purchased in very large quantities because of storage, safekeeping, and transportation issues. To help overcome all these barriers, mutual fund companies started offering gold ETFs. ETFs stand for Exchange Traded Funds. ETFs, unlike mutual funds, have their units traded on the stock exchange. Just like stocks, investors can purchase units of these mutual funds from the exchange at a market price. While ETFs are more commonly known to have stocks and commodities in their portfolio, there are also debt and gold ETFs. A gold exchange traded fund is a simple investment product that allows investors to take exposure in gold. When you buy 1 unit of a gold ETF, it is like owning 1 gram of 99.5% purity gold. Here, the gold is not delivered to you in physical form, but you will hold gold electronically in your Demat account. The value of the gold ETF will increase or decrease based on the price of spot gold in your country. Every unit of the ETF you purchase will be stored in your Demat account and you can sell it whenever you want, just like you trade stocks. Investing in gold is suggested by many financial experts as it acts as a hedge against market uncertainty and fluctuations. But you should remember that securities transaction tax, GST, brokerage fees, and exchange fees are some of the additional costs you need to pay for buying a gold ETF. So if you're looking to invest in gold as a hedge or simply looking for long-term diversification, then investing in gold ETFs has many benefits over physical gold. Thank you for watching the video.
Yeah, so that is how gold ETFs work. So it's basically like, you're holding the units of the, units of gold, but the prices will vary as per the prevailing gold rates. So now sovereign gold bonds. What are sovereign gold bonds? These are the bonds issued by the government of India. So what they pay 2.5% interest, semi-annually. Investments, you can make investments of minimum 1 gram, that is, minimum 1 gram of unit you have to purchase here. And maximum can go up to 4 kgs for individuals and for HUFs 20 kgs. The price is simply the average closing price of 999 purity gold in the last 3 days. That is a price that you can purchase for. Maturity is up to 8 years, but you're allowed to do a premature withdrawal after 5 years, subject to some taxes. Taxation, again here, long-term and short-term capital gains tax is there. 3 years is the holding period. If you come out of it before 3 years, it's short-term capital gains, and above 3 years is long-term capital gains. But if you hold the sovereign gold bonds up till maturity, then there is no tax, no capital gains tax. Gold mutual funds, we all know. So these mutual fund invests in stocks of gold producing and gold distributing companies, and some gold mining companies, stocks of gold mining companies, and that's how gold mutual funds work. So the taxation again is same as the debt mutual funds, short term and long term, and for long term capital gains you get an indexation benefit here. Now, gold prices are very, very volatile in nature. If you see the period from when, August 2020 till August 2022, you can see the price movements. They have been highly volatile throughout the period. So it depends on a lot of factors, right? Like I was mentioning, the global demand for gold. Usually it has a negative correlation to equity markets. Whenever the equity markets are doing good, we see that the gold market is inversely proportional, inversely related. So when the equities are doing good, the gold is going down. So in the year 2015 to 2019, so it was mostly in sync. Like whenever the markets are up, the gold was down. So it was usually going in a sync. But what happened later was in 2019, in this period, again it was more or less in the sync. But in 2019, there was an expectation that there will be a stock market, correction, or a correction expected. A big correction was expected in 2019, but that never happened. The equity prices also kept going up. Equity markets were doing very good. The gold prices were also surprisingly doing well. So both were going up at the same time. That is because the markets were unsure about which one, where the markets are heading. So people kept investing in both the avenues, and we saw that the demand for both of them was good, and the the gold prices were in line with stock prices as well. In 2020, because of the COVID crash, we saw that markets went down drastically. Here, the markets went down by about 37%, and that is when the gold started going up drastically. So, this is a perfect example of how gold can be a hedge to the risks associated with equity market. So, the gold was up by almost around 49-50% in this particular period. Slowly after September, when the vaccination positivity started coming in, we again started seeing that the equity markets are going up. When the equity markets are going up, the gold also, gold tends to go down. So this is a perfect example of how it is used as a hedge in the portfolio. So basically what this does is, during this period of time when your equity is performing negatively, the gold brings a edge to the portfolio where your XIRR doesn't go down in a large manner. It is protected. The gold protects from the downside risk of a portfolio. Again, in 2022, again the market started, showing a sink. The gold and the equity market started showing the sink. When the markets are up, the gold is down. When the markets are down, the gold is up. So again, it is in sync. So it is like a perfect hedge to your portfolio. Now, currently, if you see in the last few days, the news of the Adani group of companies that is leading the market corrections, right? Leading to the market corrections. So now we can see that there is a lot of uncertainty that has come in because of, again, it's a mix feeling actually because of the global recession, the layoffs. We are hearing the layoff news every now and then these days by the multinational companies. And the news of Adani, the research report of Adani Group of Companies has also led to its decline because Adani Group of Companies have a big market share in the stock market. So we see that the gold is again started to pick up. So coming to this Adani Group of Companies, a lot of there are a few mutual funds also which have allocation to Adani Group of Companies, which have got hit by this correction. But there's nothing to worry as such. This time period, we should look at as a good opportunity to invest more money rather than panicking out of this situation. So keep your SIPs going. There's no need to panic absolutely. So this is a phase which will come up. If your horizon is a longer term period, just stay invested. If you have surplus money, it's a good time to invest. So there's general observation about Adani Group of Companies because since the topic has come up, a few points are coming to my mind to share with you. So the observation is among a lot of analysts is that Adani as such is high on debt, right? So we don't pick usually mutual funds or good fund managers do not pick companies stocks which are high on debt. So the general observation is that the artificial intelligence based portfolios, which pick based on artificial intelligence, they have picked Adani based on some fundamentals, rationals. So only such investments have such funds have Adani exposure. Right Horizons has a lot of PMS strategies, about 6 to 7 PMS strategies, and in none of these Adani has a stock investment because they are very high on debt. Usually, as portfolio managers, as wealth managers, we always try and see the pros and cons of each and every company when we are choosing every investment avenue that we are choosing. So it always makes sense. If you have a larger portfolio, you should always take the help of an advisor to see where the investments are heading, what is the growth prospect, what could lead to a downside, and things like that. So what costs are involved in gold investments? So in physical gold, so every investment has its own pros and cons, like I was saying. Even physical gold, they have design or making charges which are upwards of 10% always. It depends on the type of design and type of jewelry, necklace or bangle or what it is, right? So insurance and storage charges roughly about 6% annually maximum, right? So GST is also there, which is also adding to the cost of the product. In gold ETFs, the total cost goes up to 1% annually, including the expense ratio. Then demat account charges will be there because demat is required to invest in ETFs, and brokerage charges because if you're transacting through demat account, there are brokerage charges. In gold mutual funds, the total expense ratio comes to maximum about it's in the range of 0.6 to 1.2%. It depends on the AMC basically. So, and in sovereign gold bond, there is no cost as such. Sovereign gold bonds can be bought in physical mode and in demat mode also. If you are using demat, then there is brokerage, but otherwise there is no visible expense as such. So in all the categories, if you see, physical gold has the largest cost attached to it. So this is to bring an awareness of whether physical gold or digital gold or what kind of gold investments will suit. So factors driving the gold investments are the rising geopolitical tensions. If globally there is uncertainty, the markets are saying, then the economies, the government, the people start investing in gold because that will take care of the market downsides. When there is high inflation risks, right? So then people start, markets start moving towards gold investments. Chances of global recession and intensifying stock market volatility, like we are in the present times, there is a lot of uncertainty. Could be because of the budget coming in now, because of the Adani's news, because of the BBC documentary that we are seeing a lot of rounds doing the rounds. So there are a lot of news, so this economy related elements which will drive the gold investing in India. Right. So what is the ideal allocation in gold as per our overall asset allocation? Gold is like an hedge to the portfolio, that we totally agree, right? So gold allocation should not go more than 5 to 10% of your overall portfolio. Again, it depends on your risk profile, on your financial goals that are coming in, and what are the liquidity aspects you're trying to consider. So at the max, you can have about 5 to 10% allocation of gold in your portfolio, right? So yeah, physical assets should be physical assets or gold should be taken only as gold or real estate should be taken only as a hedge to the portfolio and not as a mainstream investment. Financial assets are always better. So when when you go to any advisor, he or she will tell you that financial assets should form 70 to 80% of your portfolio. 10 to 20 should be in your real assets, that is your physical assets. That is because financial assets have a better growth rate, better taxation facilities, taxation benefits, taxation benefits, and liquidity aspects are much better. So when goals are in line, liquidity is one thing which is very important. When the goal is coming, you should have the money ready at any point of time. So easily liquidable assets are your financial assets. So always physical assets have a liquidity issue, inflation issue, and the storage and maintenance and a lot of issues associated. So you should always be careful of these. So what are the trends in the gold investing these days? So what is happening is when we talk about making gold investments for our daughters or for our future daughter-in-laws. So what is happening is they're not very inclined to gold jewelry. They're more inclined to fashion jewelry and gadgets, like I was mentioning, right? So they're more happy if you're buying some luxurious luxury products like gadgets or something what they like in today's trend. For example, it could be a luxury car. They're very happy if you give them a luxury apartment to settle down after marriage or something like that. They prefer these kind of investments rather than physical gold. So that is what is a trend going on. And moreover, the designs that we do now may be obsolete after 10 years. So buying gold jewelry for our daughter's future marriage might not be a good idea, because they might not like the designs that we choose for them. So that is one more concern. So please be careful of these aspects while you're making gold and real estate investments, and always stick to the right asset allocation. So best is to have a have your overall asset allocation assessed and thoroughly analyzed by with the help of your financial advisor, which will help you understand where your current standpoint is and what can be the best avenues for your future surpluses that you're expecting. So that's all for today, and let's take the questions now.
Thank you, ma'am. So I think we have lots of questions in Q&A section. We can take one.
Yeah. Um,
I think most of the things you already covered during the presentation only, so we can take the questions whatever.
Yeah, sure. So I'll take the first question. Is more in most of the webinars, real estate is not suggested as a good option. Then how do we justify today's topic? So today's topic is also the same, saying that yes, gold looks attractive, but not above a certain level. Like I was saying, there has to be when you're looking at an investment, it has its own pros and cons. So I think you posted this question at the very beginning. So after that, I have covered the disadvantages of having real estate. So the ideal allocation one should look at is about 20%, excluding the self-occupied property. So more mostly we should look at these asset classes as a hedge, portfolio hedge rather than mainstream investments. I hope I've answered that question, Mr. Prashant. Next question is by Mr. Umesh. Is commercial real estate loan interest and principal tax exempted? Commercial real estate loan. Okay, I'm not sure of this. Let me check on this and get back to you, Mr. Umesh. I'll have this answered, on an email. So we have your records. So I'll just mention this on the email. Can you explain the bond investment? So which bond investment? Did you mean the sovereign gold bond? So the name is not there, so I'm not sure. So I'm assuming it's sovereign gold bonds related. So sovereign gold bonds are bond investments. So what happens is you're buying units, grams of. You're doing these investments in terms of grams of gold. Let's say you're buying 10 grams of gold in sovereign gold bonds. So you get like a certificate kind of a thing. You can either have it as in a demat format, or you can have it in a physical format. So here what happens is, for your investments, let's say your total investment is about 50,000. So on this 50,000, semi-annually, you will be paid an interest of 2.5%. That will continue throughout. That interest will keep coming to you. Apart from that, the tenure is 8 years. In the 8th year, whatever the prevailing price of gold is, you will get to liquidate. You can get to liquidate your bonds at that price of gold, which is there after 8 years. So the capital appreciation is taken care. And after 8 years is a maturity period for sovereign gold bonds. After 8 years, there is no tax on your maturity amount. There is a provision of premature withdrawal, which is given after 5 years. So the government will come up with the windows of premature withdrawal dates after 5 years, and on those dates you can sell your sovereign gold bonds after 5 years. And they will come up with the price also. Usually it will be an average of the last 1 week's price or something like that. So at that price, you can liquidate your sovereign gold bonds after 5 years. So that's about it. So another one is, I have a flat purchased in 2009 for investment purpose. Is there any thumb rule or age or per years to come out of it, that is sell off? So you purchased this property in 2009. So see, you have to consider a lot of aspects when you want to sell off. So currently, what is the prevailing rate in the location? And what are your liquidity requirements? If you can wait for a couple of years till till the I don't know the demographics of this place. For example, whether it is in tier 1, tier 2, tier 3, and what is how is the real estate market in these cities, in the place where you have this apartment. And if you are in liquidity, like if you have any gold coming up, then it will make sense to take it out right now and put it into financial assets, so that it has better potential to grow in the financial assets. I hope I have answered that. Another question is it beneficial to invest in REITs? So, like I mentioned, it's a very risky asset class, Mr. Deepak, risky, and it is something very new. So, for a retail investor, I think you should be very conscious. Uh, you have to look at your overall portfolio, right? You have to first secure your emergency fund, secure your children's goals are met completely. If you're thinking of doing these investments for any goal purpose, then I think it will be a risky asset class. You should do thorough research, or take help of an investment advisor. If you want, we can have a one-to-one discussion to understand much in detail, and I can maybe help you understand what is beneficial for you. I hope I have answered, Deepak. What is the tax bracket while reselling gold in coins or bar? No, there's so if yeah, it is your income tax bracket. So if you're selling it within in the short term, within 2 or 3 years, it is termed as a short-term capital gain. So short-term capital gains will be taxed as per your income tax slab rate. Let's say you're coming under the 30% tax slab, so it will be your gains will be taxed at 30%. If you're selling it after 3 years, after the holding period, then it will be treated as long-term, long-term gains. There you will get the indexation benefit, and after indexation, 20% is the tax rate. Digital gold is as secured as physical. Mr. Sunil Nagmal has this question. Yes, digital gold is another concept that we are coming into. So digital gold is like something like cryptocurrency, which is not very regulated. So uh, I'm not very confident or sure of digital gold as an investment. So again, you should be very careful to understand what are the pros and cons of if you're considering digital gold as an investment. It best is to sit down with your advisor and talk about what is your overall objective when it comes to these investments. There are a lot of questions today, actually, but we have run out of time. I'll take a few, but remaining, I assure you, we will answer over an email. I have replied to my previous session answers also over email, so I will do that by Monday or Tuesday. I will take a few, and then we can, wind up the session. Very sorry for that. We are a little, overdoing on the time. So there's a question by Jerry. Can one extend the holding period of SGB after 8 years, or we have to exit after 8 years? Yes, the holding period is 8 years only. After 8 years, you have to, liquidate it. You have it matures, just like an FD or any other investment, right? It matures, and you can, again reinvest in the next series of gold bonds. Uh, Okay, can we build a portfolio from today onwards? Considering all my savings are used for my parents' treatment and will have to start from scratch. Mr. Deepak has a question. He says, can we build portfolio from today onwards, considering all my savings are used for my parents' treatments and will have to start from scratch? Yes, Mr. Deepak, we can, start looking at building your portfolio. And I understand you have spent considerable amount for your parents' treatment. So again, like going by the thumb rules of financial planning, the first thing that we'll have to build on is to create the safety net in terms of emergency fund, your health insurance for yourself, your parents, and life insurance, and then start from there, looking at how to build your portfolio for your goals for your retirements. So if you want, you can connect with me one to one. I'll share my coordinates with you on the screen in some time. Yeah. So while calculating rental yield, which property price to be considered, current market price or original purchase price? Mr. Krishna has this question. So when calculating rental yield in India, it is usually calculated on purchase price is what I understood. But let me get back on this and I'll answer you over the email. It is usually on the purchase price. But current market price would make more sense according to me, but let me do a research and get back to you on that. Can you explain taxation of sovereign gold bonds? Yes, I did it during during my session, and just I have answered one question. I think that will do, but I'll answer that on the email as well. So I think we have taken few important questions. Rest we will be answering on the email. If you would like to have a one-to-one discussion, regarding your specific concerns or specific decisions, because real estate and other for that matter is very subjective, and maybe I can help you through. I have I have a client base across salaried people. I'm working more with doctors also these days, so maybe I'll be able to help you based on my experience and knowledge. So please feel free to get in touch with me.